Well, hello, welcome back to Wealth Within Live. Well, again, almost live as Janine and I are on our holidays at the moment, enjoying the sun and the fun. And I hope you have had a fantastic Christmas yourself and spent a lot of time with your family and really getting to know each other again. And hopefully Santa brought you all the presents that you did want. Now, tonight, we've got another show of the best of Wealth Within Live, all our live shows, plus a little bit of new content that you haven't seen before on YouTube. Now, tonight's show, we're really going to go into comparing the current market to past market crashes. Really exciting topic that we did several months ago, and we talked about the Dow Jones and the All Ordinaries Index, and we actually went into a discussion about the market crashes and helping people understand really what a crash is, how they happen, how they unfold, and what to do about it, because all too often people are very emotional around crashes, and that causes them to make emotional or poor decisions, and therefore making poor decisions means you lose more money or you don't enable you to profit very much. So this is a great little section we're going to do. So let's take it away into understanding past market crashes.
Okay, let's bring up the charts and look at the crashes on the Dow and the All Ords. All right, I'm going to bring that up.
Otherwise
now
I'll stay on my soapbox for another hour or so.
We don't want that, do we?
No.
All right, I might have to take drastic steps.
So what we're going to do now, she might hit me again. What we're going to do now is bring up the Dow Jones and the All Ords so we can just look at how different things are now, in comparing it to past market crashes, just to show you how it is. Because now we've moved on, 4 or 5 weeks since really the start of this move down. It was sort of, as I said, about 4 or 5 weeks ago. So we get a little bit more information. So let's have a look at that. So bring up the Dow. It's in the yellow there.
Yep. All right.
So let's go back to 1929 crash and have a bit of a look at that.
Okay, can I hide all of this stuff that you've got there?
You can hide whatever you like, as long as you don't hide under the table.
Okay, it's just cluttered up the chart. Okay, so if we go back down there.
Yep.
Okay, so this is the Great Correction.
The Great Correction, that was over leverage and everything else, and that was an economic or systemic meltdown on the marketplace. It wasn't a event-driven meltdown, a little bit different. So
that was an 89% correction there on the Dow back then. So following that, the market actually tried to recover, but look how it actually unfolded. This was, even though it was 89% down, it was more similar to what happened in the GFC. So we had that initial fall, but the fall was much sharper. Look at the steepness of this fall from that October 29, and then it rose part of the way.
But if you look at it more closely, you'll find most of that first fall happened on roughly a day or so, but the market had already been falling for a bit before that big day. Okay. What we did a few weeks back is just go bang, 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 really straight off the top almost. There was no real come down a little bit, gently come down a bit, then everything happens and all of a sudden bang, this thing went bang straight away. So what we're seeing when we're looking at the 29 crash was that it was folding over and all of a sudden it went bang on that one day in 29. But the bottom didn't happen until 32.
Now so we know that after this crash, we know that in Australia, after the correction happened at the same time, in Australia we went into a depression.
Yes.
Because the government in the country at the time didn't act quick enough to put money into the economy, and that was a big criticism down the track that happened. And so when the GFC hit, the government at the time were told by economists that they needed to act and they needed to get money into the economy straight away and get people spending, which is what they tried to do. And part of the plan that the current government have employed now is actually what the government was trying to do in the GFC. But there's a lot of there's a lot of criticism for what happened back in the GFC. But look at what went on. But our property market stayed up reasonably well, which was interesting. But look at what is happening now. I mean, the amount of spending that the government is putting into place is 20% of our GDP, and they've acted really fast to try to get this going. So there's a reasonable probability that they could be right in what they're doing in stopping a depression from happening. But people are asking, are we going to see a depression? Well, if they're spending this kind of money, economists will say that that's less likely given what they're doing.
Yeah, I think a much better position now to have a nice bullish move out of the bottom, whenever that is, than what we were in 2009, because in 2009 we really went sideways for so long because of that, rescue packages and everything else that just didn't do very good.
Well, we haven't sort of talked about people yet in terms of what happened during the GFC to compare that to to what's happening now, have we? We really
No, but during the GFC, it came down from the June. It came down, and then it took off, and everybody started getting back into it, and it went up into the October high.
Yeah, because at that first pullback, people were a bit surprised, but then it was just like the numbers were looking cheap. So from the fundamental perspective, which was lagging what was actually happening on the chart in front of us.
They were cheap, they were doing that. We were getting out.
Yeah.
And we saw the writing on the wall. We were getting out and reducing all our position sizes, but then we were getting blamed for not getting back into the market when
the market took off, and then all of a sudden it capitulated and went south again. Now, it's not to say that the same thing could happen, it could happen again, but we might get more of a protracted sideways move unfolding. So after, if I can just go back to what happened in the Australian market, I need to change charts again.
Yeah, so let's just go to the Australian stocks.
Because we haven't, pardon?
Let's just go to the Australian market now. So in the green.
In the green,
at the
top?
There, no, in the middle there, that's it. There you can see it there. Just click on one of those.
Yeah, so after the correction here in 87, see how we had this rise all of a sudden. So that's what... See, there were about 4 months where the market went sideways and it actually came back and tested that low. So that's what could happen now, given we're seeing the market just very slow to move back up. But we could also then see this really protracted sideways up and down move, because let's face it, the banks are not looking great at the moment. There's still potential downside there. So a similar sort of thing could unfold here. But what happened after the GFC, the houses prices were still great. The market rebounded really strongly, and then eventually we had this secondary correction with the tsunami that happened in 2011 when the market
pulled back again. And in the GFC, well, it was a financial system meltdown. So it was a systemic meltdown, not a event-driven meltdown. And because it was systemic, and you're talking about banks closing down in America, and our banks were under scrutiny. So to me was a bit more doom and gloom. But there's something more to this coronavirus. It's
not to say that we couldn't see banks,
there's something else driving this market at the moment, and it's not just coronavirus. I've said it to Jim Beach, I think this is more of an economic war. There's not a war with bullets, it's a war with something else, and the market's being affected by it. So,
well, that's what I said to you when it first happened that first week. I said, I think this is actually like war, and we looked in the supermarkets and that was happening. That it's behind the scenes, and the oil war's going on right now.
So I suppose what we're wrapping up, what we're saying to people is, don't expect the market to be like it was in the past at the moment. It is running a little bit under without rhyme and reason. Expect it could fall further. Just because it's bounced today and bounced last week doesn't mean the bottom's in. So just really protect yourself and don't be in that state where you think you know what's going on, because Janine and I can't tell you where the bottom is. We just can't right at the moment, and we don't want to, because it could be dangerous. What we say now is protect your capital at all cost. If it starts to drop, stay out of it, and it's best just to let the dust settle.
And why is that? Because the best opportunities are going to come after that next move.
This year I think we're going to have more volatility, more false triggers, all sorts of different things for a while now, what I'm saying, and I think the best opportunities are coming in a year time. Now is the absolute most brilliant time to do our course and to educate yourself to be ready for the big run when it happens, because if you don't, you're going to miss out on stuff, and you're going to play in the meantime, and it's going to cost you money and losses and give you headaches and have you less hair like I've got. So that's really what's going to happen. The next section we've got is called Getting Rid of Deadwood. People buying and holding, and they hold stocks for dividends or dividend investing. So we often find that people hold a lot of deadwood, which keeps their portfolio returns down. So this is an excellent discussion that Janine got into. Let's go and have a look at that one right now.
Number one is, and I've read your part of the question, get rid of the dead wood. Ask yourself, have I bought and continued to hold stocks just to get a dividend? I'm sure some of you will say yes to this one in the background.
Yeah, I think there's a lot of people do that. They buy, there's lots of examples of stocks back in the last decade, and even up, in that 2010 to 2020. I don't know how many portfolios I saw that everybody had Telstra, they had AMP, they had some of those other stocks that they just got on, the government ones they got on floats.
Yep.
And you're thinking...
Commonwealth Bank, they would have done okay. But
Commonwealth Bank, they would have done really well. But, and you'd say to people, why are you holding Telstra? It's falling away. Oh, because it pays a good dividend yield.
Yep.
And it's... What people don't understand is when you've got a stock like that, and you've got an equal weight, let's say you had an equal weighting of 10 stocks in your portfolio, and this one is falling 30% a year or 20% a year, it's sucking the profit out of your portfolio.
It's the boat anchor.
It's the boat anchor, and that's part of the reason we see. And there's not a portfolio that we see, and we do see lots of portfolios, and we have over the last 2 decades. We've seen a lot of portfolios with people, because people send us portfolios in that Janine takes over for our managed account service that we run, and so we're every week or so we're seeing new portfolios and how people are investing, and so we're seeing they're hanging on to stocks for 5 and 10 years that they're still losing money on from 5 or 10 years ago, that have been falling for 5 and 10 years and sometimes longer, or they've been holding for 20 years and it's still the same price that they paid for it 20 years ago. So that's, I think, what you're meaning.
And right now, I mean, they could be at, 2016, 2017, 18. Look where the market is, look where the market was back then. You're pretty right there.
Yeah, and that's why we say to people, be active investors. So it doesn't mean to be high risk, it just means to be active and exit stocks. And so if you dividend invest and you think you're doing great because you're dividend investing, but it's looking at your portfolio not just as a stock, it's about a group of stocks or a group of investments that you're actually doing, and looking at it in that way and looking at making sure it's growing. If it's not growing 8 to sort of 12, 15% a year, then you're not being active in terms of it, and then you're just being at whim to the marketplace. And having stocks that go sideways and down for long periods of time just to collect dividends is not really smart in my book.
Look, dividend investing is an approach that has been promoted as a way to generate an income for decades, but at the market average, let's say around 4.5%, which is typically what happens over time, you'd have to have at least $1 million invested to make it worth your while, and not everyone has that.
Don't you have that?
And then again, no, maybe. And then again, who wants to live on $45,000 a year? This is probably not the income that you're dreaming of, right? $45,000, does that really turn a light on for anybody here? It may do, I don't know. The reality is, for most portfolios, this approach behaves as a boat anchor, and as it encourages people to buy and hold, and this drags down your return, right? So that's the problem with dividends, and it's been encouraged by the industry for so long for people just to pick up stocks and assume that they're going to be able to make an income out of their dividends. Everyone talks about it.
I know.
But it's you might get a payment twice a year. Is that like a Centrelink payment almost? Or
but
not?
people don't think that if I buy BHP for $30 and sell it for $40 and I make 30% on that, that's income to me. They don't think about it. That's capital gain, but they don't.
It's classed as an income, or dividend yield is income.
But it's still income for me because I've sold something at a profit. I've made money. So if I go and buy this pen for $5 and sell it to you on the street for $10, I've just made $5 income.
Yep. Okay.
So it's the same thing to me, and so people think.
And that's what they can't get their heads around.
No, to me, buying and selling stocks gives you income. So because with the portfolio, and what a lot of people may not understand is, with a medium-term portfolio, you're going to turn over 1/3 to 2/3 of that portfolio every 9 to 12 months. So as you're turning it over, you're actually pulling money, your income out. If you need to run on that, you're pulling that out of the market and reinvesting the remainder.
I think more people are starting to get it now. So not to be afraid of selling because they're worried about paying capital gains tax, because this is what they've been told for so long.
Yeah, and also that's another issue that we deal with in my book, How to Beat the Managed Funds by 20% and Accelerate Your Wealth. It's like, pay your capital gains tax. The more tax you're paying, the more money you're making. It's pretty simple.
You are speculating, if you don't look at history, because how else can you determine your probability of success? Probability is actually determined from historical data, and it gives you a basis for determining how you'll trade. So that's really what we want to cover off tonight.
It is. I know with 100% probability that every week you're going to bring up the swear jar on me, because that's your behaviour, because historically you keep bringing it up. So I know that's going to happen.
Funny you should say.
The swear jar?
Because I had a conversation with a lovely gentleman last week, and he told me that I was swearing during the conversation, which I don't usually do.
You don't swear?
Not usually, but he told me to bring out the swear jar, so I thought that was really cute.
Yeah, well, so you're bringing it up every single week. But let's go and have a look at my spreadsheet anyway. I'm going to put my glasses on. What I've done, just to share with people, is this is roughly the top 20 stocks. It's not perfect. There's about 22 stocks in there, but most of these are top 20. You can do this on all stocks in the marketplace, and basically what I've done, let's just have a look at Westpac. So what I've done is I've taken the yearly returns of Westpac from 1984, so their open, high, low, close, the percentage gain or loss in dollar terms, which is this figure, and then, the actual dollar figure, and then obviously the percentage gain or loss. And I've done that, and then I've actually summarised it here so that you can see how these stocks actually travel. So looking at here, Aristocrat, 15 years it's positive, 10 years it was negative over a 25-year period. So 60% of the time in a calendar year, it actually closes higher than it opened. Amcor, over 36 years, 61% of the time it closes higher than it opens. So remember, 1 January to 31st of December, that happens. So all these groups down here, and you can see the average of this is 22 years in total. So I've used stocks with long history just to show you some interesting things. Now, looking at these stocks in green, Bramble, 72% of the time it closes higher. CSL, 78% of the time. Goodman Group, 75% of the time. It's one of the shortest one, only 16 years. This one here, Macquarie, 76% of the time, and Wesfarmers, 75% of the time. So if I was more medium to longer term portfolio, they're the stocks I'd put into it, because 3/4 of the time they're going to trade up in a calendar year. Whereas if I was looking at more trading of stocks and compounding returns, because I know a lot of people think time in the market is important for them, you know, and I do get that a lot. Time in the market is more important than timing the market, whereas we're about timing our entries and exit. But you time your entries and exit by having good rules around buying and selling. And so those who don't have really solid rules, especially technical analysis rules, will tend to more be time in the market. And having
because
those stocks in green.
What you're saying is that doesn't really matter from a longer term perspective if you're choosing good stocks like that. But from a shorter term perspective, you could choose any of those stocks. Is that what you're saying? Correct.
And you'd put those in underpinning your portfolio. Now, a lot of people have held AMP since it floated back in 1998, I think it was, and they got it on the float and they've never sold it, but it's not a good buy and hold stock. It's terrible. Telstra, a lot of people held that from, you know, it's down 50% of the time, it's up 50% of the time, it's down. But if we go and have a look at Telstra, if you look at wherever it is, there it is, Telstra, you can see it 1, 2, 3, 4, 5 times in the last 6 years it's traded lower.
So the issue is,
people continue to hold that.
If they're just looking at the big picture, which is the first spreadsheet that you brought up, they could just look at it too simply, because it's not until you go down to the actual, at the stock level, that you see, okay, you can't just buy and hold these, because looking at that, you're going to be in the stock for 3 or 4 losing years in a row.
Correct. But I know in this period of time that Telstra has had a couple of runs where you could have made 50% in 6 to 9 months or 6 to 12 months, because this is calendar year. So let's say you bought it 1 July and sold it 1 February.
No, you actually traded it with rules.
Yeah, you trade it with rules, you would have made money. And this is what I talk about. And the reason, part of the reason why I use these stocks is because these are the ones I've used in my book. So you can see what happens when you trade it, and you get a far better return than buy and hold if you are actively investing and using some rules on it. So that's what my book proves, both Accelerate Your Wealth and my first one, How to Beat the Managed Funds. But looking at this, I'd say, look, some of these stocks here, there's a few more up around 70% as well, but some of these ones like 57% like IAG, you wouldn't buy and hold those sorts of stocks. But even those stocks in themselves
actually did better. Isn't that interesting? Because, you know, people say buy and hold the index. Buy and hold.
Why would you do that?
Buy and hold these particular stocks all the time because they pay good dividends. But clearly, what you're demonstrating, and look, this is a simplistic way of showing people, but in reality, if all they did was look at a chart, you would see that anyway.
Yeah, correct. So if you were going to buy a stock and you went, Telstra had an up year last year. You'd go, well, 50% of the time it has a negative year, so next year is probably going to be down, so I'm not going to buy it. So these are the sorts of things, assumptions you can start to make. Now, Telstra's had 5 years, negative years out of 6. We've just saw that. So what's the probability it's going to have a positive year next year?
Well, there you go. Based on the spreadsheet, you can come up with an assumption. To me, that would be a high probability that it's not going to have another downward year. It's unlikely to, because it's had so many down years already, so it's likely to move up. But if you've had a stock that's had multiple years going up, what's the likelihood of it going down the next year? So you can look at stocks like, let's go and look at BHP. Pick a big one. Pick Wesfarmers, I think.
Oh, you want to look at Wesfarmers?
Yeah.
So Wesfarmers, 1 year here, 2 years here, 1 year, 1 year, 1 year, 1 year, 1 year, 1 year. Most of the time, it has 1 year down.
Yeah, but look at that. I mean, you could be in this stock for a whole year and you've only made 2%, 1%. That's to me is like equivalent to a negative. You get 0, 1, 5, 1. for 4 years straight.
Yeah.
But you're getting the dividends, and the downside risk is very small, isn't it?
Correct. So depending on where you buy them, you might make good money or you may not.
Wesfarmers could be a trading stock, but it did go through a period where it was actually trading sideways for a long time. So that's that period there that you're looking at from 2014 across. Until 2019, it just went sideways and did nothing. So you wouldn't have made anything much out of it because you would have been whipped in and out anyway.
Correct. Most people, when they're looking at stocks, will look at what's happening today. They'll have a read of stuff, newspapers, reports, whatever it is, and look at what's today. But really with the portfolio, you do need to know its history, because history repeats constantly with stocks. It really does repeat. And
so what you're trying to show is on a spreadsheet, a simple way for people to see it, because we can bring up charts and say to you that history repeats, and when we do analysis, we're using history to determine how a stock will unfold. But what you're saying is take it a step further. Once they do the training, they'll actually see so much more of how history repeats, not just this. I mean, this is just a very basic level.
Yeah, this is just a high level for people to understand it, because we can take it even deeper than that. But you can also look at volatility of a stock. How much when it rises does it average rise? How much does it fall when it average falls? Those sorts. They're really important things. But if you're looking at buying a stock, you should know about it. And I'll wrap it up with saying that when you spend a lot of time with your partner, you actually know what they're going to do before they do it. Now, I know Janine's always going to bring up the swear jar, so I already know before she's going to bring it up that the swear jar is going to come out. I know what my wife's going to say if I come home late, or et cetera, et cetera. So you all know what I'm talking about. So shouldn't you know the stock the same way? Because if you know what a stock's going to do next week, next month, or next year, with high probability, because you studied its history, its past movements, and its patterns, then you'll be a much better trader or an investor on it, and you'll make far more money with lower risk. And that's really the goal here, to make more money with lower risk.
Now, I have rules around the swear jar. What are the rules around your wife telling you should be home on time?
Oh, it's in the fine print of the marriage certificate. Only women can see it, so don't ask me. I think they change all the time, but they just don't seem to. They says, no, it's in the rules. So it's,
okay, you're being told to move on now.
Okay, now the last section we're going to show you is actually an interview that I did with one of our students or graduates now, and talking about their journey through our diploma. Now, they are a university lecturer, they're a dentist, and they're an investor and trader. It's quite an interesting story, and I'm sure you really are going to enjoy listening to this. So let's go and have a listen to this story. Can you tell me a little bit about yourself and what you do for a living, your family, a little bit, so I know who you are and what you're about?
Sure. I'm a dentist by trade. I'm also a university lecturer, dad of 2 wonderful children. It is fairly hectic, yes.
So what initiated your desire to want to get into the stock market in the first place?
I realized that what I wanted was a bit of freedom and independence, and really having more time with my kids. On the long term, really is to pass on that legacy to, if I've got grandchildren one day, to say, hey, I did that, and you shouldn't fear it. I remember as a young child, my dad used to say, I'll just buy a few blue chip shares, put your money in a mutual fund. So that sort of lingered around in my head. And then probably 2 years ago, I decided, well, let's just read some books on this, and thought I knew what I was doing. And I sort of thought to myself, well, I'm going to set aside a small amount of money, and this will be my education. So getting educated in the market. Well, educated I did get. And I sort of reflected back and I said, well, something's not working. I really need to rethink my approach here. And so, yes, that has been my very early experience over the past year and a bit.
So what sort of challenges did you have around all of that, in terms of when you were in the stock market? Did you experience different challenges, and what were they?
I think the main challenge is to stick to a plan. I started off with a view, and I think I stuck to it. And then I dabbled again, and then I went into the, when you get a bit too confident for your own good, well, at least my own good. And I said, that's it. 3 strikes, you're out. You need to go and get yourself a proper education. That's it. I mean, it's an expensive way to learn a lesson, really. I mean, I suppose, as you say, you don't become a top-end trader investor like yourself, reading a few books. I mean, that is really ludicrous. I never thought of it that way. And I think that was the first thing, to really gain an understanding of what am I dealing with here. I mean, if one doesn't understand what drives it, I think personally it's really foolish to get in. Get some good mentorship, really learn from people who have walked that path. Otherwise, it's a painful process learning from your own mistakes.
Absolutely.
When I put my mind to something, I will get it done. But gee, I was 20 when I was doing things like that, and the stakes were not that high. The stakes are higher now. There are people who are dependent on me. I've got bigger responsibilities, and really I should start structuring my learning much better.
Now I believe you're just starting Module 1 or in Module 1 of our diploma course, is that correct?
That's correct. I've actually just finished my case study, and so I'm just towards the end of Module 1, that's correct, yes.
Oh, fantastic. So right at the very start. So did you have any preconceived ideas? Now, when you're wanting to learn to trade, do you have any preconceived ideas about learning to trade?
I must say I was very skewed in my view. As I said, it all came down to a very tunnel vision view of what I thought proper trading, investing actually means. I look at the charts and I'm like, well, I don't quite know what's going on here. I can see lines when somebody explains it, but what does it actually mean? And I think part of me actually just sort of pushed it to the background, and I thought, well, no, I don't need to know this. Well, let's just say I was grossly incorrect in that assumption.
So when you decided to look for an educator, what did you do, and what was really important to you in getting that educator?
Proper structure. That was very important to me. As earlier mentioned, I do come from a bit of an education background. I do realize there really is no shortcut to it. So I sort of said, well, I'll put on my hat as somebody involved in education and really go out there and look for someone who is going to prepare me, not spoon feed me, prepare me to become independent. And yes, along the way, provide me with the support that's required. I think a lot of things that come on the market tend to be short seminars. And I'm sure people may have some success with them, and power to them. There were some which I found to be, they might introduce a concept to you, and then you sort of always subscribing to them to get the information rather than getting the information yourself and having a good think about what's given to you. The main trigger for me really was, how much did I want this? So I had to really balance it out, and I had to think about a structure whereby what am I going to do here, and how am I going to approach my learning by really allocating the time appropriately. So that included waking up early before the kids wake up, and then I'll start my study and really immerse myself at that moment in time. And nothing's going to ever align perfectly. It will all be perfect at the end. So that's how it got me started. That's it. I just went for it.
My last question really is more a bit about, now you've started the course, what's been your experience to date, or that experience that you've had in that first module to date?
The best way I can put it, it's a very good introduction. I found the structure to be really, really good. It's so good at giving you the overview of things and then zoning into very important areas. So that is a real testament for whoever's designed this course, the whole team. The support I got from Kerry, who's my assessor, I was stunned to get a reply, I don't know, within less than 24 hours sometimes. And I really enjoyed the way students were encouraged to actually not just say, this is the question I have, what do you think? It was, this is the question I have, this is what I think this means, am I on the right track? And can I just say, just by even doing that, I have, as an educator myself in my field, actually taken that on board with my own students. So, I haven't just learned module 1 here. I've learned something more than that. And I find it very enriching. I realized it's very early in my journey, but yes, I'm even more excited now that I've done module 1 to really continue on this journey.
Thank you. That's a beautiful compliment, actually. It's and I'll pass that on to the team. Can I ask you one more thing just before we finish up? Is obviously, you've filled in the paperwork and you're ready to start the course. Now, a lot of people have a lot of apprehensions and fears and everything else prior to starting the course. Did you have any of those sorts of fears beforehand, and what's happened since that point?
I must admit, I didn't have any fear. And I don't say it from a point of arrogance. I say it with a lot of humility. And a lot of it was just knowing, and I'll be very honest, was actually to know that I have the opportunity to better myself, but also most importantly was really the opportunity to put my case forward, to have someone like yourself mentor me and take me on board. When I knew that opportunity was there, and I say these opportunities do not come every day in my life, I'm going to grab it and I'm going to cherish every single minute of it. And I just said, go for it. And when Shane told me, Rob, I know you wanted to start a bit later, but the opportunity is presenting now. The moment he said that, I said, please put in my paperwork this very minute. I'll go for it. That was it. There was no fear. I wanted this, I want this, and I'm just swinging my punches.
Fantastic. It's really interesting chatting with you, and I'm looking forward to a lot more of these little chats with you where we can explore a little bit more of, Rob's personality and how the journey is going. And so it's, as they say, we're writing the story right now, but I can see the finished movie in my head. I know where you can be and I know what you can achieve in my head, and that's a mentor. My job is to see where you can be and what level you can be at, and then help you and guide you and push you, and sometimes slap you over the back of the head to push you to get to that level that I know that you can be at. And as we say, I've got a bar that I set for somebody, and then you need to get to that bar, and I'm sure you'll get there, and I'm looking forward to the journey. But thanks for the chat today. It's been fantastic. Any last things you want to say before we go?
No, I'm looking forward to it in terms of our next chats, and certainly looking forward to really getting through to the next modules and really learning and bettering myself.
Oh,
Thank
fantastic. You. All right, Rob, you take care. Bye-bye. Well, I hope you've enjoyed tonight's show. And again, we really do appreciate you supporting our channel over the last year. And again, I do hope you've had a fantastic Christmas. You'll be gearing up now for New Year's Eve. So hopefully you've have a lot of fun on New Year's Eve, but not too much fun. You don't want to have too many headaches the day after. Remember, New Year's resolutions are only going to come to fruition if you put some action behind it, because the one thing is to set your goals, the second thing is to put action behind it. And I know from personal experience that when you take massive action or put massive action behind your decision making or your goals, then things can happen and anything can happen. And we do hope anything can happen for you in 2021, and I hope 2021 is a much better year for you, and it gets you all the goals that you desire. But we'll see you again next week on our next show.